Back in January, Mercedes reported that it had sold fewer cars last year than the year before. Then late last month, the company said profits and margins were down. A couple days ago, now they say they don't expect anything to improve, and so you know what that means. Here comes the mass layoffs. The reason why the growth scare is back all over financial markets is because fundamentally it never left. That's really the message from Mercedes. Any improvement anyone felt in the US or global economy toward the end of 2024 was really nothing more than a temporary blip based on artificial and fleeting factors. Rate cuts never work, but some people feel better in the short run. There was the election high, and most of all, the temporary boost to activity, which was tied to tariff beating, that is now quickly disappearing. All the evidence we have coming in from markets and macro, they're pointing to the steep loss of momentum. Rates are down, stocks are down, crypto's down, risk off kind of stuff. Today it was the ISM Manufacturing Index, which rolled over too, joining consumer confidence, spending, and a whole bunch of global data that all shows the same thing. As one after another businesses come to realize last year's bounce wasn't actually the soft landing confirmation everyone hoped, companies are forced to pick back up where they had left off last summer. This growth scare is about how the layoffs that we're getting more and more in cars will spread beyond cars, and that will trigger all the familiar recession signals. As we all know, stocks only go up until they see those recession signals, or more accurately, they see a plausible and increasingly likely potential they will show up. And if you wait until they do show up, it's already way too late because by then everyone else will have sold. The ISM today is the latest evidence for this rolling back over economy, while Mercedes is a reminder the situation never really improved despite the rate cuts, the election, and instead, the forgot how to grow economy has forgotten for too long, and now the risk really is that employers have finally reached that more familiar recession endpoint. It's not just stocks that are falling. Interest rates are doing the same thing, even though we haven't heard a peep from Jay Powell and his minions. The markets are all aligning for the fact that we're going back to where we were last summer because nothing really changed in between except a bunch of artificial stuff that is now more and more wearing off. And as it wears off, it shows up more and more evidence and more in these markets. What Mercedes reported previously last month was, first of all, from the Wall Street Journal, Mercedes-Benz will cut jobs and shift some production from its German home to lower cost countries as it prepares for another challenging year. Nothing is actually changing, despite lower interest rates, by the way. After reporting a sharp drop in earnings in 2024, the company said it also expects earnings to fall significantly this year too. At an investor event on Thursday, that's last month, it outlined plans to boost competitiveness that include a 10% cut to production costs over the next couple years. And some reports have said that those layoffs are going to total as many as 20,000 jobs, with other reports saying it could get to as much as 20% of Mercedes' total 166,000 worldwide employees, which would mean somewhere in the neighborhood of 30 to 33,000 layoffs over the next couple years. The car business is having to adjust to the fact that the economy forgot how to grow and that it forgot before it actually recovered from all the stuff in 2020 and 2021. Most of all, the supply shock. The supply shock had impoverished everyone and it left the car business well short of recovery, just like the overall economy. That's what's really happening here. That's where the forgot how to grow economy came from. And the car business is maybe the best representation of the forgot how to grow economy because it was a fake recovery all this time. And now that the business has to adjust to the actual fundamentals of the situation, which in this case means how many cars did they actually build, what we're seeing in more and more cases, it's been Nissan, it's Stellantis, Volkswagen, now Mercedes, they don't build nearly enough cars because the business has disappeared. And just last week, according to Reuters, Mercedes-Benz is cutting 10 to 15% of its sales and finance jobs in China and plans to reduce costs for office-based roles by a quarter in the country by 2027, at least another one of these anonymous people said. So what Mercedes had reported earlier this year is that it sold just less than 2 million cars during 2024, which was down 3% from 2023. largely because weakness in China, where it reported a 7% drop in car sales and a 3% decline in Europe, the two weakest economies, or two weakest parts of the global economy that we see. But more importantly, what they're saying here by these layoffs is they don't see a turnaround in 2025. So while prices soared in 2021 and 2022, volumes never recovered. But all of these businesses, not just Mercedes, not just the car industry, but all across the entire global economy, they kept hiring workers anticipating that the economy and these industries would recover, that volumes would grow back to where they needed them to be. And so they just hired and made sure that they had workers ready and available to take advantage of that recovery. But as they realized it didn't recover, and it's not recovering, and it's not improving, now they realize they have too many workers, too many facilities, and they have to make these painful adjustments. They have to lay off workers and close factories because the economy is not strong and resilient. It didn't hit its soft landing. There was no resurgence last year outside of temporary factors, and we're still heading in the same direction. The forgot how to grow economy, still forgetting how to grow. And so the growth scare is what happens as the global economy does revert back to its volume basis, and the markets are reminded that we didn't actually recover and things were not improving last year. So the growth scare is really this reemergence in the evidence, the macroeconomic accounts, that we didn't shift to something more positive in the middle of last year, that rate cuts didn't help, that there were no meaningful changes in the economic trajectory in November and December, and that in 2025 what we're seeing is that we're going back to it. We've already seen this in the car business. Mercedes hardly the only one, as I mentioned. You've seen offshore and overseas car manufacturers, they stuff the channels and then they send a whole ton of exports to the US trying to beat tariffs, and now only to suffer the payback from front-loading all that activity. In the United States, there really wasn't much front-loaded activity anyway, as you would expect. There's not a whole lot of reason to do so with foreign tariffs. But we've already seen the car business fall off in terms of production as well as employment. According to the Federal Reserve's industrial production estimates for last month, total domestic motor vehicle assemblies was just 9.38 million, that's a seasonally adjusted annual rate, in January 2025. That was down 8% from the previous January, even though they're going to blame that on cold weather and everything else. What you can see is that the average domestic production from 2023 into 2024 and into January 2025 was just a rate of 10.6 million units. That compared to 11.5 million units in the 2014 to 2019 period. So far short of full recovery, and things now turning in the wrong direction. The car business never recovered, but more importantly, car makers themselves as employers realize it's never going to. And now they have to make the adjustments. And as they're making adjustments in the auto business, what other companies and other industries are coming to the same realization and therefore might be ready to follow Mercedes and Stellantis and Nissan and Volkswagen into mass layoffs. Mass layoffs being one of the most striking and visible recession signals, traditional recession signals there are. As the possibility goes up that we do get those signals, got to get out of the stock market, because that's, everyone knows you sell stocks when you see the traditional recession. And that's the risk that we're starting to see from the stock market itself, that maybe the herd has shifted in the other direction. Because you look at the S&P 500, it's been mainly sideways since early December. Now, it's hit a new high along the way, but that corresponds with a whole bunch of dollar fireworks, the dollar scarcity and shortage I talked about in December and into January. That's where this growth scare really started to emerge. As these other markets started to signal that there was increasing trouble, equities began to pick up on that. They didn't crash right away, but there's been this period, this pause, this sideways action where even the stock market, which wants to go higher all the time, is saying, hold up. Let's see what's actually happening here. So we've got 3 months with no real action. Plus, there's more instability tied to doubts about the AI bubble and the effectiveness of AI to generate returns and profitability anywhere close to the near term. And that's one of the biggest things about last week. NVIDIA failed to get the market back on track. It failed to quell the fears that the AI bubble is going to contribute to the downside we see emerging, the growth scare that's emerging in all these different places. And even this past weekend, after the sell-off last week, there was supposed to be an epic short covering today, Monday, to start the week. And instead, it fizzled. While there was some short covering late Friday afternoon, It didn't really carry over this weekend. Every strategist around Wall Street was saying short covering, short covering. It's going to be epic on Monday. And then stocks were actually down by the time I started recording here. The indexes are down for today, continuing the growth scare idea. And by the way, this forgot how to grow economy and the market signals surrounding it, that's something they go over all the time. And that's what we do at Eurodollar University's deep dive analysis. We dive deep into all of these so we can make sense of what's happening today, as well as what that might tell us, or at least for the probabilities of where we're going tomorrow. That's what Eurodollar University's deep dive analysis is for, to give you all the information that we have and have at our fingertips that are available in order to make these informed decisions. Forgot how to grow becomes understanding the cycle. That's at Eurodollar University's deep dive analysis. Check out the information at our website, eurodollar.university. And you see it start to infect even mainstream coverage of equities, which is in itself a pretty substantial indication that the psychology, at the very least, which is what stocks are all about, that is actually changing as well. According to Bloomberg today, any S&P 500 recovery attempt is likely to prove temporary amid economic worries, according to Goldman Sachs Group's David Kostin. Investor exposure declined last week as the benchmark briefly erased its 2025 gains, but it isn't low enough yet to suggest, quote, tactical upside as a result of depressed positioning. That's what Kostin said. An improvement in the U.S. economic outlook will be required to fully reverse the recent equity market weakness. So they can see how it's macro uncertainty, growth scare potential that is now infecting stock market psychology. And he wasn't the only one. There's another one. To Florian Ielpo of Lombard ODA Investment Managers, markets have been expressing growing concerns about a potential slowdown in the U.S. And again, that's potential slowdown isn't really the slowdown. It's seeing a plausible, credible pathway to achieving those recession signals that everybody is on the lookout for, the traditional recession signals. And the more and more you see that pathway become more and more likely, the less likely you want to sit there and own stocks. And here's another one. The message of caution needs to be heard. And depending on Friday's payroll, that's the upcoming report for February, this deteriorating macro momentum could cap markets' progress. That's according to Morgan Stanley's widely followed strategist, Michael Wilson, who said equities are likely to be more sensitive to economic growth than even to a pullback in bond yields. But of course, as we know, bond yields are only going lower because this growth scare is reestablishing some certainty over the future path of short-term interest rates, which means the Fed. Well, the Fed is pretending to be on both sides of the fence. We really know its institutional bias is toward what they call inflation. But the weaker the economy gets, the greater the plausibility of the downside, the growth scare not being just a scare, the more we know that the path for short-term interest rates is going to clear up on the downside, which is why we see interest rates that are falling, lower growth expectations. We've got the two-year yield right at 4% today. It was below 4% a little bit last week. That's a new low that we haven't seen since the middle of October. The 10-year rate, the 10-year Treasury rate down to 4.19 today. That's its lowest since December 6th and continuing to look like it's going to go lower. The 3-month 10-year spread, that one, as I pointed out last week, has reinverted. And that reinversion has deepened as the 10-year goes lower and the 3-month kind of stays the same, which, as I mentioned last week, is all about the market knowing that the fundamentals are being reestablished and more clearly. At the same time, it will take a long time for the Federal Reserve to recognize those fundamentals and act on them, just like we saw last summer too. There's a very much a June, July vibe to what's happening in the marketplace right now. And so that's not a surprise in the bond market or interest rates. It's more about clearing up all of these fundamentals and clearing up how even the Federal Reserve will have to see them too. And so Mercedes plays along in that because it confirms, it's another piece of confirmation that shows the economy is not improving globally, the US too, in 2025. Everyone was hoping for a soft landing. And here's Mercedes saying, no, the car business that was already concerning last year, we see it actually getting worse this year. Therefore, because it's getting worse, because we never recovered, because of a whole bunch of factors, the artificiality of the supply shock period, we've now got to make major adjustments in our business. And the more obvious it gets in the car business, the more obvious it's going to get in other businesses. And therefore, it raises the risk that layoffs are not just Mercedes and other auto manufacturers. They become more widespread, which gets back to the stock market. When they see layoffs in stocks, when stocks see layoffs, that means traditional recession, get out of Dodge. And so the other part of that is more and more macroeconomic data that we're getting this year that suggests that artificial high from last year in the economy really was artificial. So we see all of this data that's rolling over. Talked about consumer confidence before, spending, retail sales, personal spending from the Bureau of Economic Analysis. Now here's another one, the ISM Manufacturing Index. Not really surprised here either, because we've known about the tariff beating activity and how much artificiality that's created for manufacturing, but still we're getting confirmation here that suggests exactly, it's another one that says the same thing. And as we get confirmation that last year was indeed fake and front-loaded, that means there has to be payback here in 2025. So the more confirmation of artificiality in 2024, the more you have to be concerned about heading into the spring of 2025. Now, the ISM index only fell back to 50.3 from 50.9 in January, but 50.9 isn't all that high. And it was the first time the ISM had been above 50 in forever. So already rolling over suggests it didn't go all that far to begin with. It wasn't a deepening recovery. It really was artificial, and now it's heading back lower again. We see that in orders. The new orders index fell to 48.6. Again, evidence of payback after the artificiality. The employment index, 47.6, down from 50.3, which means that the reason the employment index spiked over the last several months was simply manufacturers bringing in just temporary help in order to meet all of this tariff beating production. Yes, there is domestic production that is related to beating tariffs, because you have to have all these components come in from outside the United States that might be subject to increased duties and costs. And a big one that a lot of people have been focusing on with the ISM, the price index hit 62.4, which was its highest in 2 years. And that's not inflationary. That's not indicating resurgent price pressures in an inflationary manner. It is indicating that the ISM and manufacturing sector are suggesting that tariffs are going to raise prices temporarily, but as we see, whenever we get prices raised, what that does to consumers is it destroys more purchasing power. They can't afford it. And for businesses like we see surveyed in the ISM, that means higher input costs, which are not going to be passed on to customers because customers can't afford it, which means more squeezing of business margins. And as margins get squeezed, more and more of the manufacturing sector ends up like Mercedes. They have to lay off workers and cut costs because everything is moving in the wrong direction. There isn't any revenue growth. There isn't any new orders or new sales coming in. So higher input costs are just one more negative on a system, on an industry or sector of industries that just can't afford it. So this growth scare isn't really a growth scare, and it isn't really about cars. Mercedes, as I said, is a good example because the auto industry is. The industry never recovered. The economy never recovered. And now businesses have to do something about that, because now realizing that it was never a recovery, the soft landing isn't happening, there is no pathway toward recovery, they now have to take and make big adjustments to their businesses to better align with fundamentals, the forgot how to grow economy fundamentals. And as they do that, they only contribute more and more negative pressures to the forgot how to grow economy, raising the chances that forgot how to grow becomes the more familiar recession dynamic. And as the chances of a more familiar recession dynamic go up, the stock market pays attention, because that's the only thing that triggers systemic selling in the stock market. So the fact that the stock market has gone sideways over the last couple months, maybe that's just a temporary thing, but it also could be even the stock market starting to see the same signals encapsulated in the term growth scare for what they really are. The economic fundamentals were always bad to begin with, forgot how to grow, but now they're deteriorating and getting worse. So the ISM, Mercedes, the rolling over economy, interest rates, crypto, the stock market, all of it brings us back to where we were last summer, where Jay Powell was last summer, not wanting to admit that things had turned, but then quickly changing his mind, or having his mind change for him. The forgot how to grow economy is at risk of forgetting how to grow for too long. This isn't just a manufacturing thing either. Talked last week about how it had already impacted the services and how it was rolling over in consumer confidence. That's all in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.